Today, we're hopping inside of the dividend growth portfolio that I shared down below in the description, and we're hopping into one of my top holdings. It's been consistently one of my top positions, and the position is V stock, ticker symbol V, standing for Visa. Now, Visa currently trades at $213 a share, and it's a stock that has not only went up a lot over the last 10 years, currently providing 471% performance, not including dividends, but the company's actual business, the actual business fundamentals in terms of its top line revenue, its bottom line profits, have all been going in the right direction, as you can see from these charts right here. Now, Visa is not only a stock that has grown a lot in the past, but it's one that's going to grow a lot in the future. And not only is it growing a lot this year, but it's growing astoundingly well despite the recession. 18.72% growth in the most recent quarter, and profitability in the most recent quarter as well is at all-time high record levels, growing 48% year over year, which is just insane to think about. So we're going to talk all things Visa in this video, talk about foreign exchange headwinds that the company's been facing. We're going to look at not only the America segment, but also about all these other categories that are very important to the business. We're going to talk about share buybacks. We're going to talk about dividend raises and overall return capital to shareholders, and how this is the most important part of Visa's business model, and how investing in the company like this could get you ample returns from waiting on share buybacks to take place, and then return capital in the form of dividends, which seem to seemingly go up each and every single year, which is raised every single year in December like it was this year. So it's going to be a fun one. Stay tuned. Let's go ahead and get started into Visa stock. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, let's go ahead and get started with their most recent quarter, which is their fiscal fourth quarter. They reported a year off. This is actually when it ended September. It's the fiscal fourth quarter. I know it probably can be a little bit confusing, but the thing I really want to focus on here is the foreign exchange headwind, with basically what that means, if you're not familiar, when the value of the dollar rises, and when you have a company that's incorporated inside of the US, which all the companies I review on my video are, pretty much 99% of them, obviously when the dollar rises, that means other foreign currencies typically go down in value, which means the money that they bring in are less valuable. That's less revenue, that's less profit for you to bring in. And revenue from these segments is very valuable for Visa and is obviously a huge part of their business, as you can see right here. 583 billion in terms of volume in Asia Pacific. Canada was 104 billion. CMEMA, which stands for Central Europe, Middle East, and Africa, was 260 billion. LAC, which was Latin America and the Caribbean, was 305 billion. You have 1.6 trillion in the US and then 649 billion in Europe. Now we're going to talk about this and talk about the growth differences, and you can see obviously here the foreign currency impact made up about 4% of net revenues in terms of a negative amount. Its actual operating expenses was 4.5%, which means not only is it killing top line by about 4%, but it's killing bottom line by about 4.5%. And that bottom line as a profitable investment, which is really what you're looking for. This revenue growth of top line needs to go up, of course, for you to have a profitable growing investment, but what really matters is the free cash flow. Can the company expand their margins? And we're going to be talking about more on margins here in just a second as we overlay all these different charts here in just a second to compare where the company's at today versus where it has been over the last several years. Now, if you look at this, you can see that Asia Pacific grew roughly 4.1%, okay? But the constant currency, meaning if the foreign exchange did not happen, it actually would have grew 15.2. Canada grew 13.6. It actually would have grown 17.3. Now you see the one exception to this is CMEMA. You can see that was pretty much negative 20% and change, no matter where you look at it, constant currency or not. But other than this one hiccup, everything across the board was vastly different. LAC was 25.2, it would have been 32.9. You see America, that's the one exception, that's inside the United States, so that doesn't get affected. And then all these others. You see Europe actually shrunk negative 5.6%, and it actually would have had growth of 11.6%. That one category right there as an example would have had a 16% growth rate difference just based off of a foreign exchange. So I want to highlight something here. When you look at its top line revenue and you see that it grew roughly 18.72% in the most recent quarter, 7.79 billion is impressive, but when you think about how much this could have been if we didn't have foreign exchange headwinds, this very easily could have been a 20-25% growth rate just this most recent quarter, which is amazing because Visa is one of the largest businesses on the planet, currently sitting at almost half of $1 trillion market cap at $450 billion. Now, profitability did come in at record levels, but same story here. Who knows how high this could have been if we didn't have all that other stuff to worry about. And one of the cool parts about Visa stock-based compensation is that it's so negligible compared to the free cash flow that it's pretty much non-existent. So that's a cool part there. Now, one thing I want to mention is, speaking of stock-based compensation, this takes me to the next part of this video, which is return capital to shareholders. And one of the reasons I love Visa. In their most recent quarter, they purchased 10.8 million shares of Class A stock at an average price of $197.50. And that's what's so cool in the most recent quarter. You can see it, they're buying the dip on these low price shares. Their average share price was around here, right around where my mouse is, which obviously that's the average, but basically they're buying just as hard down here when the stock is tanking down to 180, 175, all those low prices where you want to see companies buying back shares at, of course. So not only that, but they have been buying across the board throughout the year as well. You can see that in the 12 months ended September 30th, Visa purchased 56.2 million shares, which is roughly 5.5 times what they did in the most recent quarter at an average price of $205.97. Now, obviously, over the last 12 months, the share price has been higher, so that's why the average was a bit higher at $205. But generally speaking, when you see throughout most of the year, you can see that this stock price was much higher in the 240s, the 250s, the 230s. And so having the average buy-in price at just $205.97 shows that management is really focusing on using their share buybacks when the prices go down. Now, they used $11.6 billion of cash to do that, and they have $5.1 billion of remaining authorized funds for share repurchases, but they just increased that an additional $12 million. They had 5.1 left, they added another 12 billion on top of it, so they now have 17.1 billion, and on top of that, they increased the dividend, just a very small 20%. Not 2%, it's not a typo, 20%. Visa has a track record of raising that dividend incredibly fast. Right here, you see where it raised almost 20% in 2019 from 21 cents to 25 cents. You see here where it raised another 20% in 2019 from 25 to 30. 30 to 32. It raised this lower amount in 2020, being cautious. What is that, like 8 or 9%, doing the math in my head. Then they raised from 32 to 37.5, and then from 37.5 to 45. That is a 20% raise, and you can see how over time that dividend has gotten better and better as each year goes along. Furthermore, like we said with shares outstanding, something that's really cool with Visa, like I mentioned, is that if you look at their free cash flow, it's incredible. Out of that $7.7 billion, over $5.5 billion ends up on the free cash flow bottom line. Now, their stock-based comp, see this little bitty blue, that it's so small you can't even really see it. That's the stock-based compensation, what they have to pay the high-level CEOs, the high-level managers to run the business. It's so small, it's not even a line item. It's so small, it's so negligible. And that allows them to buy back shares at an incredibly fast pace and actually put a dent in the shares outstanding. And one of the key things to look at here is not the actual number, but the percentage that it's going down. Basically, you can see shares outstanding went down 2.52% in the last year, which is the equivalent to the company paying a 2.5% dividend. And when you consider the fact that this company also has a dividend that is almost 1%, you can see that the company is returning capital to shareholders in the form of about 3-ish% a year in the form of capital return through share buybacks and share repurchases. So when you see how fast this company is raising its dividend, when you see how fast this company is buying back shares, when you see how fast this company is growing, and lastly, when you see how fast this company should be growing when you factor in the foreign exchange headwinds, it's pretty shocking how fast Visa can grow. So it will continue to be one of the largest positions in my portfolio. It's a company I love, a company I want to invest in, and one that I'll likely be holding for the long term in the dividend growth portfolio. Thank you guys so much for watching. Thank you MooMoo for sponsoring this video. Check out all the stuff down below in the description. Thank you guys so much for watching, and I'll catch you all next time.